I'm going to talk not about being an angel investor, but being a fund manager. So as you'll see at the end of this, jump to one of the conclusions, is some of the graduates of the angel conference did the conference a few times, felt comfortable in being an angel, and then went off and raised a fund. I did this when I started Fledge. Fledge is run as an investment fund. And so I started by going out and raising funds. First and foremost difference here is when we talk about fund management, we're typically talking about raising a bunch of capital that's not yours, that's other people's capital. In Seattle, again, the typical check size for a direct investment into a company is $25,000. The typical investment size into a fund ranges from $25,000 to $50,000 for a small fund, or $250,000 to $1 million in a large fund. Now, the rest of this, I'm going to go over what the different choices are when you create a fund. So choice number one is, do the investors commit capital to the fund? When they sign the paperwork to join in the fund, do they have to write the check or wire the money right then and there? And so typically in small funds, the answer is yes. The answer is, yeah, you sign the documents, right? It's a bunch of legal work to become a member of the fund, and then you immediately owe the fund whatever the check size is, $25,000, $50,000, $100,000. The alternative to that is the more typical path for the large venture capital funds, which is called callable capital. So in that form, you promise to invest $1 million into a venture capital fund. They will call, as they say, let's say the first 20% of that. So you have to write them a check, as soon as they ask for it, of $200,000, and they will call the rest of the capital over the next few years. And that term of how often they'll call and when that is will be in the documents. And it's typically more or less 20% per year for 5 years. With investments, big investments get in the way, they need to call more, they'll call more. A recession or other downturn in the market, they might call less in a given year. But those are the two types of ways to get the money into the fund. Second thing to think about when you're starting a fund is, what does it invest in? So that's the same as running an accelerator. So what stage companies are you going to work with? Idea stage companies, companies that have the prototype done. So that would be kind of pre-seed. Prototype in the market, but no paying customers would be pre-seed. Seed funding would be either to make the prototype happen or to get a realistic number of sales. These terms are debated here in the States on what they mean. Startup capital would be where the angel conference would like them, which is we have some traction, they have some customers, they have some revenues, they're ready to grow up. And then growth, which sounds like it should be there, is usually meaning later on. Like they have $1 million in revenues already, they want to get to 10. That would be growth. They have 10 million in revenues, they want to get to 100 million. That would be later growth. They have 100 million, they want to get to $1 billion. That would be late stage, still growth. But growth would be, think of it best as $1 million in revenues. And so just thinking through that, the companies become less and less risky the further down this path that you target. And there are fewer and fewer of them. And when we start to talk about emerging markets, well, if you're not going to do the pre-seed fund, who is? Where's that money going to come from? So if you think about this in terms of an ecosystem, maybe what you need to do in your city, in your country, is you need to do an angel conference for the earliest stuff and an angel accelerator for the middle, and then a fund to do the startup and the growth stage. That might be the answer to how you personally help build out the ecosystem. A few more questions. Do you make, as a fund, only one investment in a company and then you're done? Or do you set aside money to make multiple investments in a company? No matter what kind of company that I've worked with, everybody always wants more money. Really rare to find an entrepreneur who's satisfied with what they have, even if they're making $1 million a year or $500,000 a year. They usually want to make their company bigger. Money helps them get there quicker. Are you going to be the fund that supplies them the next round of money, or are you going to wait for some other fund to do that? That's also a debatable question. In the early stage funds in the United States, it's about a 50-50 mix on whether or not companies write one check or multiple checks. For later stage, full-scale venture funds, it's always multiple rounds. Okay, back to questions. Again, what sector are you going to invest in? So is it doing anything in any SDGs, or are you going to pick 3? Or is it just agriculture, or just fintech, or just tech, clean energy, or whatnot, or just food or whatnot? And where are you going to invest? really, when you sit down with investors that have done this, whether it's an angel or a fund, they have answers to all these questions. They have figured out that I want to invest in this stage, and I'm only going to invest in my city, or only in my country, or only in this region. Or when we get to the impact investors, it's often, I'm not going to invest here because Seattleites are too rich. I'm only going to invest in South Asia or Latin America or Africa or something else. So it gets to be quite a complicated set of questions just when you're sitting down to figure out what your fund's going to do. And then there's more. So if we're talking about doing a fund associated with an accelerator or a fund associated with a group of angels, is there one fund per session of the accelerator? You might be running 2 sessions a year. Or do you do one fund per year? Or maybe it's one fund that makes investments over 3 years or over 5 years. The typical style of this for accelerators is most often one fund per session. The Seattle Angel Conference does one fund per session. Second most popular is one per year. The little funds that go along with the angel groups are typically one per year or one every other year. The full-scale venture funds are typically 10-year long, that's their target, but they only invest for the first 5. We would call that a 10-year fund with a 5-year horizon or a 5-year investment period. I've been dabbling, my latest version of this, I'm doing 3-year investment horizons because I'm trying to show investors they can make money quicker. But that also drops to the next question, which is, if your length of time for making investments is more than 1 session, do you let new investors in? Do they all have to come in before you say, let's go? Or do you say, let's go as soon as you have a minimum number of investors to make sense, and then let other investors in later? If you let them in later, how does that work? Full-scale venture funds have this really complicated formula for figuring out how to catch up on fees and all this. My fund is rather simple. I raise money for 3 years. We spend it for 3 years. Investors can come in whenever they want. If you put in $100,000 early or $100,000 late, and there's $1 million in the fund, you own 10%. Moving on to things you need to worry about as a fund manager, which is also what you need to worry about a bit running the angel accelerators. What's the investment going to be? What style of investing is going to be made? Debt or equity, or a mix of both, especially if you're doing a fund, you're going to be making a bunch of investments. Do you do anything that's needed, or are you strict? We only make debt investments, we only make equity investments, or neither. My fund does everything, but we try and do everything we can as revenue-based investing. And if you didn't see that workshop, it's in the recordings. I did that in Singapore. And so there are ways to do things in between. Most funds pick one or the other. Just did an analysis of investors in Africa. I went to the Callable Africa conference. We had about 45 investors tell us what they do. And in Africa, the answer was they do everything. It was a very overlapping mix of debt, equity, and grants. And so we saw there half of the grantors were making investments, and they were doing a mix of debt and equity. Okay, and then lastly, no, actually, I think we have another slide after this. Next is how long you're going to expect to see your returns. So we saw from John's data that typically we're talking about 5, 6, 7, 8, 9, 10 years. You got to remember that if you're investing for 5 years, let's say, and then it takes 10 years to harvest every last bit of result from that, that's a 15-year fund. And if you're investing for 3 years and it takes 7 to get everything back, well, that's a 10-year fund. 10 years is a long time. When we talk about funds, when we talk about investing in startups, we're talking about taking money away from rich people, but we're talking about taking money and handing it off somewhere else and not returning most of it for 7, 8, 9, 10 years. That it's like sitting in a black box. They can't have it back, completely illiquid. That's really where the risk is. The biggest risk that investors see is, well, I have no idea what's going to happen in the next 10 years. I might need some money in the next 10 years, which is why they only invest 5-ish% of their wealth in this kind of investing. It's just locked away for a long time. So I'm trying to shrink this down to 7 by saying we're going to invest for 3 years, return the bulk of it using the revenue-based structure in the next 5 or 6 or 7, and it'll probably go 10 or 12. It always goes longer. Okay, moving on. I got 3 more of these. How do you pay for this fund? So this is one that a lot of fund managers get hung up on. There's a very common style that's been going on in venture capital world for about 30 years, and we just shorten it down to 2 and 20. When you get pitched as a rich person in the U.S. by a fund, you'll ask them one of the due diligence questions. If they don't tell you, you ask them, "Are you a 2 and 20 fund?" And more often than not, their answer is yes. And the way you parse this is to say the 2 is the management fee. And sometimes they'll say it's 1.5 and 25, or 1 and 20, or 1 and 15, but usually it's 2 and 20. So what that means is every year they get to take out of the pool of all the capital that's been promised to the fund, not just the capital that's been called, but everything that's been promised to the fund, they take 2% of that per year to run their fund. So if it's a $100 million fund, they get $2 million a year to run the fund. That's the cost of paying the rent in the really nice office space, flying around to board meetings, everything they're doing, they're paying out of $2 million a year, which sounds lovely, and it is. Except the investors don't really like to pay that fee. I don't know any investors who like the 2% fee per year, because 2% over a 10-year time period is 20%. So if you're taking 20% of the capital out of the fund, you're lowering the odds of returning the 25% that you're expecting to return. So you get a lot of pushback there. The other flaw with the 2 and 20 for small funds is if we do the same math on a $1 million fund, well, 2% then is $20,000, which in nearly everywhere in the world I know of, that's not enough to pay the legal fees to get the fund off the ground and running, and pay the taxes and everything needed. It's just not big enough. So the 2% doesn't quite work for the small funds. Okay, the 20 in 2 and 20 is called the carried interest. And the way that works is typically that the investors, whatever they put in, each of them individually, if they put in $100,000, then they get the first $100,000 back. Every time money comes back from one of these investments, it goes into an account, and once a year or so it gets handed to investors. And so the investor gets back whatever they put in, and then everything above that's considered profits, right? We just ignore inflation in this world. So everything past that is profits. And that profits is typically split 80 cents per dollar to the investor and 20% to the fund. And that's called the carry, or carried interest. And so that's where the real money comes from for venture capitalists. It's the 20% share of the profits. And it's typically profits after the money's been returned, but in some funds and in the emerging markets, it's probably going to have to be this way. It's 20% on top of something else, which we would call the hurdle. So a lot of the real estate funds will return 8% as 8% annually on whatever you put in. You get back your money plus that 8% compounded until you share profits with the fund managers. And so in the emerging markets where there's a known inflation rate, you may have to set your hurdle at that rate, or you may have to say in your paperwork, we're going to add that we're going to create a hurdle based on whatever the inflation actually was. That way you keep them whole. In terms of getting rid of the 2% management fee, the way I do that in the Pledge Fund is I don't charge anything to the investors. I have a 0-20 fund. I charge everything that it costs me to run my fund to the entrepreneurs. So when I make an investment of $20,000 in cash to an entrepreneur, to a startup, I'm actually telling them that no, it's a $37,000 investment. The other 17 is the cost of running the program. And so I get to take all the costs of running my whole fund and basically charge it to the entrepreneurs instead of the investors. And the entrepreneurs are not complaining about this to me because I'm running an accelerator and the entrepreneurs can see the value. I've never seen a venture capitalist get away with this because it doesn't look like they're doing any work. Like the entrepreneurs are not feeling that the venture capitalists should be paid for doing due diligence on this company because the entrepreneur knows that their company is great and should be invested in anyway. There are other ways of trying to lower that fee and deal with it. I like the accelerator model for having an out on this 2 and 20 model. Okay, last two things to think about. Who makes the decisions? So John mentioned the seed change fund. Every investor is involved in making the decisions. We would call that an investment committee. Who's the investment committee? So is it everybody who's in the fund? Is it a subset of the investors? Is it a certain number of them, or is it whoever wants to be in the investment committee? Not every investor actually wants to do this work. One of the benefits of doing a fund is it allows you to take money from investors who just don't want to do the work, who want someone else to do the work. And so you can do that for them, or you can get a group of investors who do want to, pull up their sleeves and get into the dirt. You can ask them to join your investment committee, or you can set it up so that you get final say and they can advise you, but they don't actually get to pick. And so all those are possible, and I've seen all different models. In the full-scale venture model, it's the partners. I'll talk about this in a second, but the founders of the fund, the people who run the fund, are the ones who make the decisions, and the investors have no say whatsoever. And then the last thing on here is anything else you can think of in terms of these funds. There aren't too many other options that I've seen out there, but one of them is, especially on a new fund, how can you make a change? If you suddenly find in year 2 that you need to change something in order to grab an opportunity, such as you said it was just equity, but somebody needs some debt. How do you make that change to allow debt to be made? Or the other way around, it was debt, but you have an opportunity to come in on a company that's doing exceedingly well and make an equity investment. How do you make that change? Or how do you make the change to investment committee? Typically not changing the 2 and 20 model, not changing your fee structure. That would be that'd be a taboo area to try and change.